In today's special market perspective, we'll discuss Silicon Valley Bank and its recent failure. We'll also be looking at the government's response and the steps being taken to restore confidence in the banking system. But first, I want to talk through how money and portfolio assets are held in custody at firms like Charles Schwab and their recent acquisition, TD Ameritrade. We'll need to distinguish the difference between banks and brokerages. For banks, think checking and savings accounts for cash deposits and loans for autos, businesses, and home mortgages. Brokerages, on the other hand, custody securities like stock and bond portfolios and provide access to trade in capital markets. Importantly, Schwab provides both banking and brokerage services. In Schwab's press release today, they reaffirm that investments at Schwab are held in investors' names at the broker-dealer. These are separate and not commingled with assets at Schwab's bank. Now we'll talk about the backstop within banks and brokerages. Within banking, the FDIC insures up to $250,000 per each depositor per insured bank and for each account category. This means that if a bank goes belly up, depositors are protected up to these amounts. On the brokerage side for Schwab, there is both SIPC, Securities Investors Protection Corporation, and a supplemental coverage policy to protect account holders with coverage north of $150 million per account with aggregate limits. Keep in mind the securities held within brokerage accounts are subject to risk and loss. SIPC, along with supplemental coverage, protects against the brokerage firm going under, not your stocks losing value. Now let's talk about the recent bank failure. Silicon Valley Bank was ranked the 16th largest bank in the country based on asset size. This marks the largest bank failure since Washington Mutual in 2008. So what happened here? A timing mismatch between bank assets and bank liabilities. See, banks operate by taking in deposits and either lend or invest those deposits using a fractional reserve structure, wherein banks are required to only set aside a portion of depositors' cash, with the remaining being lent out or invested. Investments commonly include things like treasuries and mortgage-backed securities. Now, over the past year, these investments held declined in market value due to a rise in interest rates in the market. This change in interest rates is part of the issue here. The other part of the story here relates to the depositor base. Silicon Valley Bank worked with many venture capitalists and tech startups. This concentration led the bank to be prone to industry-specific challenges. Surprisingly, less than 20% of Silicon Valley's bank deposits were under the $250,000 FDIC insurance limit. This means that a majority of the deposits were not covered for FDIC insurance. For a comparison, Schwab Bank recently reported having more than 80% of depositors insured dollar for dollar. In summary, interest rates moving higher, a concentrated deposit base, and a relatively low FDIC insurance coverage led the conditions for a run on the bank. Friday night, it looked like a run on multiple banks was imminent. Over the weekend, the Federal Reserve, the U.S. Treasury, and the president of the FDIC met and agreed to a plan to help restore confidence in the banking industry. The plan includes quickly making bank depositors whole, including those amounts above the FDIC insurance limit. Furthermore, the plan allows for banks to access additional money to meet withdrawal demands. The Treasury stated shareholders and certain unsecured debt holders of these banks will not be protected. Senior management has also been removed. Any losses to the deposit insurance fund to support uninsured depositors will be recovered by a special assessment on banks as required by law. For the time being, this has restored confidence in customer deposits. The market reaction? Over the past few market days, bank stocks broadly have moved lower, as you might expect. Interest rates have dropped substantially. This is an evolving story, and we will continue to watch.